Well, the last 6 months have been something of a roller coaster for the valuation of the pound. It is the worst performing currency of all the majors over the course of that last 6 month period. It has lost more than 7% of its value against the US dollar. It's also underperformed materially against other currencies such as the euro. So this begs the question, is it now time to start thinking about buying sterling? Well, what we have seen, of course, over the course of the last 5 or 6 weeks is a significant increase in sterling short positions within the speculative market. We've seen short positions extending to levels that we haven't seen since September last year. However, those shorts have yet to reach the sort of cyclical highs that we saw in spring 2017. And why does spring's 2017 matter? Well, of course, that's the time, or around the time, when the UK government triggered Article 50, so starting that stopwatch for the Brexit process. Now, it is still the case that the uncertainty on the political side is continuing to afflict sterling and continue to weigh on sterling valuations. And it's notable that whilst the politicians have gone away for the summer recess, but the political risk has yet to dissipate. And indeed, over the course of the first week, or less than perhaps a week of the Johnson premiership, it could be argued that the political risk which is undermining the valuations of sterling has become even more extreme. As the no-deal rhetoric has really ramped up, we now have the Brexit war cabinet charged with making the exit process prove real and realistic and moving that forward by whatever means is necessary. So international investors in particular have been looking at the sterling story and saying, well, the political risks have increased materially. And also in the context of the interest rate cycle, it may well be the case that the market is correct in now starting to price in Bank of England cuts rather than hikes, which we were seeing not so long ago. And indeed, in that context, I think the market will be looking for a change in the guidance or some of the language being used by the Bank of England come the August quarterly inflation report. Because that previous held mantra of slower and limited or gradual rate hikes in the UK, I think, is going to be increasingly challenged because of the hard Brexit risks. So there is a lot of negativity in sterling. We have seen it falling fairly significantly. We've traded through a number of key levels which we haven't seen since 2017. And indeed, if we do break down through the current lows at around 120.110, it does open the way for a retreat back towards the 120 threshold against the US dollar. But the question is that a time to maybe start to think about buying sterling from a longer-term valuation perspective? Well, I think one of the reasons why we would expect sterling to recover over the medium to long run is that we still assume most likely that the hard exit scenario will be avoided. The probability of that hard exit we would ascribe at CIBC at less than 10% when Theresa May tendered her resignation back in May. That probability had probably increased to around 30%. By the time that Boris Johnson was announced victor of the Conservative leadership campaign. And now, as he's continued to advance that rhetoric, we're now talking of maybe a 40 or 45% probability. But it is still not yet the overriding outcome or the overriding likelihood. So I think for those that are prepared to ride out the political risks, and of course there is an evident game of poker being played by the leadership both in the UK but also across the European Union in terms of the Brexit negotiation process. If you are prepared to ride out that game of political poker, then there are potential opportunities to pick up sterling at relatively cheap levels here. And I think it is notable that we have seen, of course, the equity market performing relatively well as we've seen sterling cheapening. And I think we are and will see some interest from overseas investors to pick up cheap UK assets down nearer that 120 threshold against the US dollar. So if you're prepared to withstand the political risk, and of course that is can create some volatility over the next 2 to 3 months in particular, and that may well threaten that 120 threshold. But if you are prepared to withstand that political risk, then looking at buying sterling down nearer the 120 threshold against the US dollar probably does make some sense. But of course, it's not a trade for the for anything other than the brave, because of course, if 120 does give way, then the technicians will be starting to dust off the charts from 1985, and we will inevitably start talking about those all-time lows back towards 105. But that is not our central case scenario, but politicians are the central risk scenario going forward.